Sam is presenting his Kansas City mobile home opportunity zone portfolio spanning 2 states, it looks like, both Kansas and Missouri, the broader Kansas City metropolitan area.
Okay, Jimmy, thanks so much. Sam Hales, CEO, founder at Saratoga Group, and really all we do at Saratoga Group, or all we've done for the last 6 years, is invest in mobile home communities. I would encourage anybody that doesn't really know about mobile home communities as an investment sector. If you Google that, maybe Google Green Street Partners, you'll find that not only has this been basically the best performing asset class in real estate for a long time, but it's projected to continue to outperform because of the imbalance in supply and demand for affordable housing. So Kansas City. This is our disclaimer. You can read this at your leisure, but basically we're not selling securities today. This is our team. This is our leadership team. And what I can say about this team, a lot of experience here, but basically everyone on this team is all in on providing dignified, affordable housing in every community that we operate in. We're in 17 different states. We have over 100 communities, and we have about 6,400 pads. Each pad is where a mobile home will go. Estimated conservative value is about $360 million of that portfolio. So this opportunity in Kansas City, it's actually a portfolio of 7 communities, and it just so happened that 3 of them were in opportunity zone, 4 of them are not. And because of the huge tax advantages of the OZ, we decided to bifurcate the portfolio, offer separately for the 3 in the OZ and the 4 not in the OZ. These were all aggregated by another operator over the past few years, and because of partnership issues, they've decided to sell. I can tell you that this same portfolio was in escrow back in October, November for 35% more than we're now paying. So we're excited about the price. We're excited about the portfolio. As Jimmy mentioned, this is it spans both sides of the river there in Kansas City, and so let me just kind of show you what we have and what we're buying. So in blue are the 2 communities we already own in Kansas City. So we've been there about 1.5 years. Really like the metro. Kansas City is a Midwestern city, but it continues to experience steady population growth, and is number of companies that have come in there just continues to be at least regionally a very good place for kind of investment, real estate investment, as well as net migration. But once we own this portfolio, 233 lots that are not in the opportunity zone, 221 that are, that'll put us at about 600 pads in Kansas City. And one thing that we have not underwritten in our pro forma is that as we get that kind of scale and efficiency, we expect, and we've experienced, that our operating expenses will decrease. So for example, our biggest market that we're in is Greenville, North Carolina. We have about 1,200 pads there, and we're now operating an expense ratio of about 30%. We've underwritten 45 to 50 for the next 5 years in this portfolio. So if we can get close to what we've done in Greenville, that it'll be much better than what we've projected. This is obviously opportunity zone investment, so it will be a 10-year hold. We actually are long-term holders. Out of the portfolio we've had, we've sold 1 community, and that was simply because it was in California. Other than that, we really look for ways to incrementally add value over time and continue to grow operating income and continue to grow distributions. So that's really what's unique about what we're offering today. Unlike everything else that's been shared in the real estate side, this is not a ground up development. There's current occupants, there's current income. In fact, we're buying this at a blended cap rate of a bit over 8% going in. It's really, in terms of a risk profile, much less risky than a ground up construction project. So really what we're looking at doing is we're going to be able to start distributions after 1 full quarter of ownership and operation. And then it's how do we continue to incrementally add income and add operating cash flow to the portfolio to investors. So the biggest way that that's going to happen, and this is showing kind of the occupancy across these 3 properties, is we're going to add units, we're going to add residents. That is, it is incremental, and it's also non-trivial. But unlike, again, if we're doing a total ground up or even a full redevelopment on an apartment building, you have to kick everybody out, or you're starting from the ground, you don't have any residents. In this case, the residents that are there are so happy to see new streets going in, new driveways in a home that they've lived in maybe for 15 years, a new playground going in, new signage. So we're upgrading everything that's already in place. Four Seasons is one of the communities. This is in Warrensburg, Missouri. Warrensburg is on the southeast side of the Kansas City metro. It's basically half full. So there's a lot of infill that's going to be required here. And we're looking at a pace of about 10 homes a year. So it'll take really about 6 years to fill up this community based on those projections. And we're going to see an increase in rent the first year, going from $350 to $400. We own in this market already. The community that we have in the market, we're at $450. And so, you know, it'll take us probably 3 years to get to market on the rents. We try not to be egregious in the rent increases, but just kind of relatively modest rent increases. And
this is also going to take a relatively big CapEx budget. So we're looking at about 1.6 million for this project. A lot of that's going to be new streets and driveways. You can kind of see a photo here. Those streets are pretty beat up. Driveways also need to be redone. And then a big chunk of the rest of the capital here is going to be used for bringing in new homes. We'll have the homes themselves financed, but as far as setting the homes, installing decks, and doing all the hookups to water, sewer, electrical, that sort of thing, we're coming out of pocket for that. Then we have Lincoln Park. This is in Ottawa, Kansas. Ottawa is on the southwest side of Kansas City, and this is almost completely full. You'll see 98% occupancy. So that means there's one empty lot here.
But the other thing is this one comes with a few park-owned homes, meaning those are homes that we're going to own as the new owners of the property, and then we're just renting out the home. That's not ideal. Like, we prefer to have people own their own home, and so there's going to be a transition with this community as we turn those park-owned homes into resident-owned homes. As part of that, some of these homes are relatively old, like 1980s vintage, and so some of those are going to probably end up getting pulled out, and we're going to bring in some new homes as part of the strategy of Lincoln Park. Majestic Hills is at Excelsior Springs. This is a great
submarket on the northeast side of Kansas City, and it's kind of in between the other two that we just talked about. It's about 69% occupied, so there's still quite a bit of infill to do, and there's definitely quite a bit of road work. So none of the homes here have driveways, so we're going to pour new concrete driveways for all the homes, and then we're going to need to redo the roads here as well. And then, of course, another chunk is the homes and getting the homes brought in and set up. So here's a projection on the cash flow
related to an $100,000 investment into this opportunity. I'll just point out really quickly, you see kind of the increasing distributions for the first 3 years. We raise enough capital to kind of fund the homes in the first 3 years, and then starting in year 4, we start using some operational capital to fund homes. I know I'm about to run out of time here, so I don't want to cut into Jimmy's time too much. Let me just share the sources and uses with you quickly. What you'll notice is big chunk of equity, right? So we're in terms of leverage, we're talking about $3.7 million on a loan and $6 million in equity. So we're really looking to, again, we don't need to bring on a lot of leverage to make this work for investors. The loan that we're going to have is a very attractive loan in the current environment, 7.15% fixed for 5 years, first 2 years of interest only. So I hope you will consider investment into the Kansas City portfolio. Please reach out to us, invest@saratogagroup.com. There's our office number. If you're an investor with us, you can scan the QR code. It'll bring you to a data room. But if you just email us, we can also provide the offering materials. Thanks so much.
Great. Well, Sam, thanks for joining us today. Let's get to a couple of questions. One question is, when do these properties typically start cash flowing after you come in and you renovate them? When can investors expect to start receiving some cash distributions?
So yeah,
We do quarterly cash distributions, and the first distribution will start after 1 full quarter of ownership. So, I mean, could we say right away? Well, not quite, right? It'll take a few months, but basically, these are cash flowing assets. They're cash flowing now.
Yeah, that's very impressive. So this is actually, Sam, your deal differs pretty substantially from a lot of the ground up deals that we heard from earlier today, where those investors are taking on a lot more risk with ground up construction, and it might take 2-3 years to get those assets built, stabilized, and cash flowing. Yours are cash flowing, maybe not exactly on day one, but pretty soon thereafter. That's fairly impressive. Do you do any, excuse me, do you do any new developments, or is it always you're going into existing properties and cleaning them up, putting in some infrastructure?
Yeah, well, and that's a great question. So we've actually built our own construction company. We have a project going right now. We're doing a 50 lot expansion outside of Omaha, Nebraska. We have another project in an opportunity zone in San Antonio, and we're doing like 850 pad expansion there. So yes, we'll do full development, but our bread and butter is basically taking something that's there and just renovating and improving it. Everybody stays in place, right? That's why we can deliver that cash flow while we're actually doing the project.
Yeah, we just got a question in about the cash flow, and I don't think this pertains specifically to your Saratoga Group mobile home park OZ fund, but can pertain to any opportunity zone fund. What is the tax treatment of the cash flow? It's just income, I think, right?
It is, yeah, it's just income. So the cash flow is taxable as ordinary income. And then when we have the refi events, that's return of capital. And obviously that's not taxable under the OZ structure.
Now, are you doing any depreciation though that might help the investor offset that income?
Yeah, absolutely. So we will have a cost study done on this. As we've looked at it from our perspective, we believe that over 50% of the investment on the first K1 will be available as bonus depreciation. So in other words, if you invest $100,000, the K1 should save $50,000 or more in bonus depreciation on year one.
Perfect. And then one more question we just got in from Julia, and then I'll let you get out of here, Sam, because we're going to wind down the day. But Julia, you got the last question in. Are you rent mobile home lot only, or including mobile? I'm not sure what she means by that, actually. Do you see her question there? Can you decipher it?
Boy, let's see.
Are you renting mobile home lots only or including mobile homes? Not quite sure what you meant by that, actually. Sorry,
Okay.
I didn't
No, I
pre-screen
think
that question. It just saw it come in.
No, I think I understand. So we are renting some homes, but that's not our business model. So generally the business model is we just want to rent out the lots. There are some park-owned homes that come with this, and over time, we're going to be selling those off to the residents. So it's going to be a mixture, but most of it is just renting the lots.
Perfect. Sam, you've got your info on the screen there. Please do scan that QR code with your smartphone camera, not your point and shoot camera like I was trying to do earlier with Greg, or reach out to Sam and his team, invest@saratogagroup.com, or the number on the screen there as well. Sam, hold on just a second. I'm going to actually just type that out. So it's invest@saratogagroup.com. Is that right?
That's right.
All right.
Awesome.
So there's Sam's email address. That'll go to Sam and his team, and he can get back in touch with you. Sam, thanks so much for joining today and being a presenter on OZ Pitch Day.
Yeah.
Really appreciate your time.
Thanks, Jimmy. Appreciate it.
Thank you.